Welcome everyone. Today it is the 17th of April 2023, and on the 20th of April we will see the inflation figures for the March 2023 quarter. I am very excited to see if the consumer price index starts slowing down and declining, or it remains persistent above 7%. That's tough. Well, in this video my aim is very simple. I just want to think and provide a different approach to inflation, a different understanding how we shall perceive inflation in general. In this endeavor I will have four main duties. First, I'd like to clarify something about the CPI. Second, I'd like to introduce a concept, the liquidity trap, which will help us understand the current situation. In the third, I want to provide a very simplistic framework to understand inflation. It's not the traditionally used cost push or demand pull framework. It's gonna be the productivity shock framework. Hopefully you will find it interesting. And in the fourth part of this video, the fourth element will be how I would recommend to ease out inflation in New Zealand, which is quite high in 2023. So first, what is the CPI? Consumer Price Index. Now this index should measure only those items which are practically consumer goods. Now the main separation from asset price inflation and asset price index is that this consumer price basket shouldn't include anything what we don't buy on a regular weekly or monthly basis. For example, housing. Yeah, we don't buy houses every month, or we don't buy cars every month. However, Statistics New Zealand attempts to measure how much we would save up for such an item, such a long-term investment, or how much we might pay as a rent or mortgage or car loan installments. So these are calculated in the consumer price index. Their overall weight is 28.5% after the 2020 inflation basket review. But in general, it is not asset price index, and it doesn't include corporate shares, cryptocurrencies, any investment items. No, it is just the consumer basket, what we buy every week or every month with some frequency. Now, having said this separation, the second element of this video, the liquidity trap. Now, what is a liquidity trap? In order to incentivize investments in an economy, reserve banks, central banks usually lower the interest rate, so more and more investment would become profitable. However, and this is the big issue, there is a limit to lowering this interest rate, and Keynes realized this problem in the lead up to the 1929-1933 Great Depression, that actually it was a futile exercise from central banks to reduce the interest rates, because there were no more possibly explorable profitable investment. This is the liquidity trap. When interest rates are very low, they can't still induce more investment. And I would say this was the problem after the 2008 global financial crisis. Interest rates went down so that central banks couldn't incentivize the economy any further, and they had to start those practices of printing money, which is, in a civilized form, it's called quantitative easing. Now, I don't think we heard anything else during the last decade than quantitative easing. Yeah, it was a futile exercise again, because it didn't increase investments. Altogether, in the United States, for example, corporate profits were reinvested only 8% rate. It's very low. The rest, 92%, was paid out as dividends or invested in purchasing up corporates' own shares to curry flavor small investors. It led to a bubble, of course, but this shows the problem. Investment rate was very low, so practically it showed the economy didn't have new profitable investment options. And the anecdotic recommendation for stock investors is when any corporate purchases a headquarter, which is a very itty-bitty real estate, it is then the time when you should sell the shares of that corporate, because, and the economic explanation behind this anecdote, if any corporate invests into a headquarter, that means the core business do not have any more profitable options. That's the big problem. So the growth of that corporate is saturated. Now let's go to the third element of this. Oh, by the way, one more important aspect to the liquidity trap. I believe this liquidity trap produced an environment, it was sustained for more than 10 years. That during the pandemic, when governments attempted to maintain consumer demand, and they started, like here in New Zealand, schemes like the I wanted to say it quickly. I will remember later on. I don't. My brain is a bit off. Anyway, wage subsidy. Yeah, that's it. There were other schemes like the wage subsidy, like the corporate resurgence payment here in New Zealand. Now, why did they do that? Yeah, they forgot the risks of inflation coming back, because this long period with the liquidity trap environment, everybody forgot about the possibility of inflation. We might have having inflation again. No, nobody thought about it. Okay, coming back to the third part. As I said, I recommend a new, very easy framework to understand inflation, consumer price index inflation. It is the productivity shock framework. Now here we can, of course, differentiate between the positive productivity shock and the negative productivity shock. This is the point where I want to highlight that not all kinds of inflation is wrong. For example, let's say we have an economy which has three components, three sectors. Agriculture, industry and services. And in one of the sectors there is a positive productivity shock. Now that sector might allow higher wages for their workers. If skills are transferable between the sectors, that means that competition for the workers will intensify, and in order to retain workers in the current sectors, corporates might increase wages, but they didn't have the same productivity increase in their own production. Now that's a problem, because they give away wages which are not backed by the same productivity levels. That causes inflation in the economy. But it is actually necessary, because this kind of inflation is kind of the lubricant of the economy, how it smoothly develops. Now, I think this is the positive case of inflation. What we have now is negative productivity shock because of the COVID disruptions, because of the intensive level of sick leaves in the recent years, and also because supply chains were severely affected by lockdowns. And in this environment, the sustained level of overall demand, yeah, of course it created problems, and it was almost inevitable that inflation would rise. As I said, because of the liquidity trap during the 2010s, I myself didn't expect it. And although I am always a skeptical economist, what I saw was, for example, increasing the minimum wage might have led to increasing unemployment rate, but I wouldn't think about inflation either, so I was at fault myself too. Now, the current situation is coupled with the liquidity trap. There are no good investment options overall. There are some, but overall we can't see many. And this is coupled with the negative productivity shock. Well, everything is practically real economic element. So the way out from this kind of inflation is actually not monetary policy changes. So what I would recommend, fourth element of this video, the possible way out, what I would recommend is the economy should address all those bottlenecks which were created by the negative productivity shock. We must find new ways to recreate productivity. Now, how do we do this? We need time, and for this period of time we have to support those who are the most vulnerable, and if there is negative growth in the economy, we shall increase the benefits and the minimum wage to the extent of inflation plus the GDP growth. If it is negative, benefits should be indexed by the inflation minus the GDP growth, but never above the inflation. Wages can grow above inflation if the growth is positive, because that creates the gap between benefits and salaries, incomes, that incentivizes more people to look for work. Now, this is the first part. The second part is that because both the negative and both the positive productivity shock can trigger spiraling inflation, wage cost and wage and price spiral. That's one of the most known, when workers demand wage rises because there is inflation and corporates have to increase their prices to compensate themselves, to maintain their profit rates. However, there is another spiral, which is the price spiral. It is simple. When it is an inflationary environment, corporates which don't face increasing cost pressures, they might still increase their prices because they can allow it, because in an inflationary environment it can be expected by customers to pay for those increases too. So it's easier to increase prices when the overall economy have inflation. Now, all these spirals are expectation based. Did I say it right? Expectation based. Yeah, expectation based. Sorry, my English is a bit low and I am on a Monday night, quite dark, waiting for the rain. Anyway, expectation based inflation. Now, if expectation based inflation are here, which I believe it is, the main role of economic policy makers is to look competent. Now, you know my videos about Grant Robertson's biggest blunder and other incompetencies, like when the government announced that they intend to index and peg benefits to wages, which will create disincentives for people to look for work. Well, anyway, so we don't see competence on the government side. And recently I read some articles published by the Reserve Bank officials. Okay, so competence is not the best there either, to the least. I hope Adrian Orr is listening in. I am open to work, he can hire me. But anyway, that would be the first. Economic policymakers should look competent. Second, central government offices should provide that they expect inflation to go down, so all those local taxes like the property rate and other government levies, immigration fees, in healthcare visit fees, they shouldn't grow at the rate of the past inflation. They should grow at a lower rate. And also, if New Zealand had any centrally prized industries, for example, telecommunication was regulated until 2000 in my home country, in Hungary, and every year the government didn't raised telecommunication prices at a lower rate than inflation. This created an efficiency pressure on those corporates. Now this would be useful here too. Efficiency expectation towards government. Yeah. And the third, actually unions and corporates should negotiate wage increases, which might be lower than the past former years' inflation, but at the same time corporates might promise that they would not raise prices according to the past inflation. This kind of negotiation was present in the 1970s in the United States still. Actually, that was one of the clues why the United States could beat inflation in the early 1980s. It wasn't just the very high interest rates, no. Actually, oddly enough, raising interest rates can only destroy the demand in the economy. So those industries which would remain profitable anyway, they might still suffer more. So actually, by increasing the interest rate, the Reserve Bank creates another negative productivity shock. It should stop. I think the best interest rate would be somewhere around 3.5%. Adrian, are you listening? And then the central banks should just wait it out. Anyway, unfortunately, because I don't see competency in the government, this kind of psychological element of the inflationary pressure will remain. So that's it for today. After the 20th of April, I will analyze the current situation with inflation. I hope this was helpful. Ask me in comments if something was not clear, because yeah, I also forgot some words in the process. Thank you for your time. Thank you for watching, and see you in the next one.